Imagine you're at a party and someone walks in and you immediately know the vibe just by looking at the room. That's basically what a market index does for the entire stock market. It takes thousands of messy, chaotic stocks and squishes them into one number so your brain doesn't explode. The S&P 500, the Dow Jones, the Nasdaq. These aren't just fancy names people say on TV to sound smart at Thanksgiving dinner. They're basically scorecards. And the economy is the team that never stops playing. Here's the wild part. You don't own the index. It's not a stock you can buy like a slice of pizza. It's more like a thermometer. It just tells you how hot or cold things are running out there. When the S&P 500 goes up 2% in a day, that's roughly 500 of America's biggest companies collectively having a good Tuesday. When it drops, well, someone had a very bad Tuesday, and it probably trickled down to your retirement account whether you noticed or not. Now here's where the benchmark thing gets genuinely useful and a little humbling. If your portfolio made 8% last year and the S&P 500 made 22%, congratulations, you technically lost. Not money, but opportunity, which in investing is basically the same thing. Think of it like running a race where the index is always on the track too. And if you're slower than the index, you might as well have just bought the index and gone back to watching Netflix. That's actually what most financial experts quietly recommend, and it drives active stock pickers absolutely crazy. Indices also act like a mood ring for the entire economy, which sounds silly, but is actually kind of profound. When manufacturing slows down, when unemployment ticks up, when people stop spending, the index usually feels it before the news anchors even finish their coffee. Back in 2008, the Dow Jones fell about 54% from its peak, and if you were watching that number, you could feel the whole financial system wobbling like a table with one short leg. Indices don't predict the future, but they do whisper really loudly about the present. Here's a misconception that trips a lot of people up. Tracking an index is not the same as panicking every time you see a red number on your phone. Checking in regularly means you're informed, not that you need to sell everything and move to a cabin in Montana. The smart move is to check your index performance, maybe once a week or once a month, and compare it to how your own investments are doing over time, like a slow and steady report card. You're not looking for drama, you're looking for patterns, because the market loves patterns almost as much as it loves making you feel like you have no idea what's happening. There's also something kind of reassuring about the fact that since around 1926, the US stock market has averaged roughly 10% annually, not every year, not smoothly, not without stomach drops, but over time. The index is basically proof that sticking around usually beats freaking out and leaving. Different indices track different things too. So the Nasdaq skews tech-heavy, the Russell 2000 tracks smaller companies, and the Dow only follows 30 companies, which honestly feels like grading the whole class based on 30 kids. Knowing which index you're comparing yourself to matters a lot, because you wouldn't compare your marathon time to a sprinter's 50-meter dash. The coolest thing about this whole practice is that it takes something overwhelming, like the entire global economy, and gives you a manageable way to check in without needing a finance degree or a Bloomberg terminal. You're basically reading the pulse of capitalism every time you glance at that little number. Regular index tracking won't make you rich overnight, but it will make you the kind of investor who actually understands what's going on, which puts you miles ahead of the person who just hopes everything works out. And hoping is a great life philosophy but a terrible investment strategy. So the next time someone mentions the S&P 500 dropped, or the Nasdaq surged, you'll know exactly what that means and why it matters to your money. And if you want to keep learning tools and ideas like this, check out our links in the description to learn more about what our company can do for you.